Record. There we go. Okay, this is being recorded, and I mentioned this at the beginning of every single webinar. Watch it again, because the first time through, you may not remember it a week or two down the road, but if you watch it again, it's going to put this into your long-term memory. Another thing, you might be thinking of questions or maybe even getting a little lost on some of the math here and there, but the second time through, it will definitely go easier, and you will be able to remember it for a much longer period of time. All right, so let me go over a couple of things real quick. My name is Eric Wilkinson. Some of you guys may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. I started trading in college with some money I had earned, then decided to switch my degree from psychology to finance. And after graduating with a finance degree, moved to Chicago and started working on the floor of the Board of Trade. Sold all my stocks and bought my badge, and I've been trading my own money ever since college and continue to do so even to this day. So got to go over this disclaimer. Any opinions, news, research, and analysis or other information contained in this webinar or material provided by ProTrader Strategies and or associated companies or employees is general commentary and does not constitute investment advice or solicitation to buy or sell any of these securities or strategies. You know, this statement is true, and it should go a blanket statement across the board. Unless somebody really knows what's in your portfolio or knows your risk parameters, they should not be giving you investment advice. And so what I'm doing is trying to teach you another way to trade in your portfolio to increase your probabilities of success. Everybody should have some stocks and some other alternative investments in their portfolio. That is the only way to really get ahead in this game. If you just have stocks, you might not even be able to compete with just the S&P, right? So make sure you have a lot of different things going on in that portfolio to mitigate many of the risks and to spread out your portfolio so that it is very diverse. All right. And bottom line is, do your own homework. Remember, the past performance of any trading system or methodology is not necessarily indicative of future results. All right. You guys can follow me on Twitter at Wolfman's blog. Earnings season is around. I usually throw out my earnings trades. I'm sorry, I forgot about Microsoft yesterday. I actually tweeted it, but never sent it. And you can follow us at ProTrader Strat, our parent company, for all kinds of good wisdom and everything else. All right, and this is going to be on the long iron butterfly. Now, many of you guys that have seen a lot of my other webinars, I haven't done very many webinars on the long iron butterfly. It is one of those strategies that I don't like to use a whole lot, but I'll use it maybe 3 or 4 times a year. That being said, with this strategy, you need to have a lot of things lining up and have a really good feeling that something's going to happen rather dramatically and in the very near term in order to get the bang for our buck that we want. So we need to have a lot of things working in our favor. All right. Let me go over a couple of these questions. I see somebody, the THC gives you the high, why the CBD hemp only has the medicinal use. Good to know, Wally. Didn't know that. I thought the THC was the medicinal aspect of it. So that was a discussion, you guys, that we were having on before this about the marijuana stocks. Eric, on a side note, a couple of times when I went to listen to your daily comments, I could see that they're not hear you. Did anyone else tell you that? Yes, Ted. Last week I was having some problems with my my microphone, my Yeti microphone, which is the one that I'm using right now. It was the software I used to capture the daily market commentaries was trying to default to my camera, and the camera microphone doesn't work. So they were fighting over each other, I guess. So I had to figure that whole thing out. I made the mistake of unplugging my microphone to use that USB port for something else, and then when I plugged it back in, everything went wanky again. So sorry about that. Took me a couple of days to figure it out. All right, so we're building on the long straddle, you guys. All right. So the long straddle we did a couple of weeks ago, right? The low volatility. All of these strategies are low volatility. Don't get me wrong. Now with the iron butterfly, you know, when we're doing the long straddle, I wouldn't do it necessarily interchange the two, like look at both of them. Because with the long straddle, I'm looking at, remember we were talking about, we want low implied volatility, anything below 50. But then you guys remember I prefaced that I would go as low as you can go in the teens or even single digits is the best case scenario, because that's about as low as volatility will be. Now, with this one, we can kind of have a little bit higher volatility than what we would normally implement with the long straddle. So if the long straddle, we're usually kind of playing around with stocks under 25 implied volatility percent. And don't let me lose a lot of you guys on the implied volatility percent. That's something we're going to go over here in a second. But, and something that I'm assuming some of the people that have watched the earlier webinars are familiar with. But the long straddle, we want super low implied volatility because we don't want to pay a lot for that strategy, right? Well, with the long iron butterfly, it's kind of like we really think that there's a big move happening, but it's not really in line necessarily with all of the rules that Wolfman was talking about, being that I'm up around the 35, 45. That's where 35, 45 implied volatility percent, that's where I'm going to start looking into implementing the iron butterfly. Now, the iron butterfly will work in a super low implied volatility environment, and it can even work in a really high implied volatility environment that we're currently in. It will fall in line according to a lot of my other rules other than the environment. So you're going to need to make sure when you're implementing this iron butterfly that the implied volatility percent is going to be a little bit higher. Now, this is, again, the straddle, that example we went over from last week where we're looking at the target 82.5 straddle. I threw that in there because it was pretty close to where we are today even. But volatility obviously has increased a little bit since then. With the long iron butterfly, then we're just going to throw an out of the money put and an out of the money call in there. Now, remember, when we were looking at this straddle, just the at the money put and the at the money call that we were buying, we were trying to make that delta, have our deltas be neutral, where we were buying 100 long deltas in the calls and we were buying buying 50 long calls on the at the money and then buying 50 delta at the money put. So those deltas, basically offset. So make it delta neutral, right? Long 50 deltas here, long negative deltas here means those are offsetting, okay, at the 50 delta, trying to make those as delta neutral as we can. We're still going to go for that, all right? But then we're going to sell these out of the money puts and the out of money calls. Now, where do we sell those? We have to figure that out. Well, I'm going to give you, there's a couple of different ways to break that down. One is we're doing the 50 deltas on the call and the put. We're going to be looking at about the 16 delta on selling the out of the money call and the out of the money put, right? That's my wheelhouse, right? When we're talking about these out of the monies, I'm usually talking about that 16-ish delta. That has to do with that one standard deviation move. All right, so that's what we're looking for here is that 16 delta. And I'm going to show you another way to do the math, and it's basically going to come out with the same situation. So this is an example of target where we built it out. Obviously, we moved a couple dollars higher since that last trade because it's about a week later. But what we're looking for in this straddle is we did the 85s right here, the 285 call and the 85 put. Now, when I got that collection, it was around $8, okay? So I'm selling a couple of calls to lower that. Now, what happens? $8 to $6 lowers our break even on both sides by $2, okay? Because we paid less. And you remember on our straddle, we had to do our break even on both sides with that premium, the break even to the upside and the break even to the downside. The same thing's going to happen here a little bit later when we go over that. But what you can see is that 16 delta gives us an extra $2. Now, the probability of this underlying getting outside of my defined risk aspect, people might ask, why are you defining it if you're taking that risk anyway? Because the 16 delta is a very low probability that I'm going to be in the money on either one of those shorts at expiration. There's only a 16% probability, okay, that either one of those or that the call is going to be in, or that the put is going to be in. All right. So that's a low probability happenstance, for lack of a better phrase. That's probably the worst phrase I could have come up with, but occurrence. All right. It's going to be a very rare occurrence for that to happen. So I'm willing to lower my break even, increase my probabilities a little bit by defining that risk. Okay. And that's what it's going to look at. The other one continued out. Remember, if we looked at this one, this was going to continue on to infinity. This one shows you we are going to have a cap on the downside and the upside here. All right. So my rules, when we're looking at the rules for success here, we need to talk about the environment in and around this underlying. Now, it's going to be the same. We want low implied volatility, less than 50% for a stock and less than 30% for an ETF. All right. Now, remember, the ETFs have a lower parameter because there's it's a basket of goods, and those volatilities will kind of meld each other out. With the stock, we want below 50 IV%. Now, with this iron butterfly, you can start getting closer and closer to that 50%. On the straddle, I was saying get as far away as close to the teens or single digits as you really can. This one, it's giving you a little bit more leeway, and I would say stick with below an IV% of 50. Now, if you thought that implied volatility, like right now we have pretty high implied volatility across the board, and we have earnings coming up. Now, you're going to have to do a little bit of digging into your assumption here, because if you expect volatility to continue to expand, then I would say, that ends up being a yellow light. You're thinking, okay, I'm really close to that over 50 IV%, or I am just above that IV%, but in about 2 weeks, they're going to have earnings. So we would expect implied volatility to increase going into that underlying's earnings, right? So if you have that assumption, then you can go closer to that 50 on the expectation. Just know that it starts becoming more and more difficult to achieve that goal the higher the implied volatility is, right? It will have a tendency to slow down as we're going up. All right, so picking the right underlying. With this one, we need something like I showed you in that example of Target, or I just so happen to have Target up here, but a stock that's under $100, we need to look at the bid ask and make sure that the monthlies that are closest to expiration, which is going to be about this November. I usually pick the ones that are closest to expiration, unless there's only like 5 days left in the monthly. It's called the spot month. It's the one that the most volume and open interest has. That would be the spot month is November then. So our bid ask should be on a stock under $100 inside of 10 cents. So look at these and say, all right, this is 10 cents or better. We're good to go. The other thing is if it's over $100 stock, like Johnson & Johnson here, $100 stock, we move the decimal 3 ticks to the left, and we could say 14 cents is how wide it should be to the bid ask. And you can see that Johnson & Johnson fits that rule as well. So that's your ballpark when you're going through this. If somebody gave you, or you saw something on TV and you decided, you know what, I think it's ready for a breakout, I need to look and see if this works with options. That's the rule of thumb, because there are a lot of stocks out there. Think about it, how many stocks are traded on any given day. There's not always the option participation in that underlying. Okay. So make sure this is the way to figure out if there is participation, volume, and open interest in that underlying. And you can also flip back and see, quite a bit of volume going on in this underlying on any given day. So that being said, a lot of volume means a lot of eyeballs. A lot of eyeballs means free market price discoveries happening, and people are making tighter and tighter markets. If the markets are really wide, it means that there's probably only one guy in there making a market, and you're going to have to go to him. And you're going to have to give up that edge. All right, picking the right duration. Now, we've talked about this duration aspect, and I put my chart in the wrong place there. Oh, no, there we go. So the right duration, we want something outside of that 35 to 45 days to expiration that we are normally talking about. Inside of 35 days to expiration, we get a lot of theta decay. And we don't want that theta decay to happen when we are buying an option strategy, okay? We want to limit that theta decay. And the only way to limit that theta decay is to go further out in time. And the benefit of going further out in time not only limits our theta decay, it also allows us to have more time to be right. It also allows volatility to affect us more. Generally speaking, volatility is going to affect the further out the curve option strategies than the ones that are closer, okay? So all of these things being said, we're trying to get further out to have those positive effects affect us more and those negative effects to affect us less. And that wheelhouse of outside of 45 days to expiration to about 70, 80 days is really where I'm kind of looking, maybe even 90 days is where I'm looking. If there's not that one right in there and it skips the month, it goes out to say like January, then that's where I would go. I would not go closer. I would rather go further out in time than closer in time. Okay. I'd rather go further away from that accelerated theta decay, which ends up looking like a curve, kind of like it'll go like across the board. I don't know why pin won't pick up. So on the duration for theta decay, it'll start out like this, and the closer we get to expiration, it starts picking up precipitously and then drops off. So we want to get outside of this range, and this starts picking up at around 45 days, okay? Start ramping up, and inside of 35 days, it really even starts banging away. So we want to get outside of that 45 days to expiration. All right. And then picking the right strikes. I talked about this briefly. A couple of rules here. When we're picking the strikes, I told you about it's going to end up being the short strikes around the 16 delta. But one thing I talk about a lot of times when I'm saying the red light, green lights, and things of that nature. Here's my red light, green light setup. For a green light, we are going to pay about 3 to make 1. So it'd be a $4 wide strategy if we paid $3 to make 1, or somewhere right around less than 65%. We want to pay less than 65% the width of the spread. So $10 wide, $6.50, right? It's 65% the width of those strikes. Now a yellow light would be paying 4 to make 1. So on a $5 wide, if you had to pay $4 to make that $1, all right, that's a yellow light. And then a red light is anything, basically, if you have to pay $5 to make $1, just kick it to the curb. I would rather then, in that case, just go with the straddle, right, to increase my risk or increase my profitability further out. So if it goes with a red light on the iron butterfly, but you really thought this was going to make a big breakout, then I would skip the short aspect of the wings here. Just get rid of the wings, which is the short call and the short put, and then throw in the straddle. Does that make sense for everybody? Okay, good. So picking the right strike. So that being one of them, $3 to make 1 or less than 65%. Another way you can kind of do it is when you're flipping through this and you do the 2 strikes. Let's just pull up the regular platform because I'll show you. It'll be a little easier. So let me just go to the target one because that's the one I was using in the example previous. And we're going to skip this one. That's too close. Somewhere outside of 45 days to expiration. So we're going to be looking at these two, 45 to 85, and we can kind of flip through both of them. So let's look at the Ds because that's a little bit closer. And the underlying's trading 83, 84. So it's kind of a pick 'em between these two. So let's look at the delta and the gamma. So closest to the 50 is probably, it's still a pick 'em, but it's probably this one. So we're going to buy the 85 strike, okay? The 85 strike in target. So now I've got a $7.70 debit here. Now what I have to think, what I do here is I think, well, how far do I have to make my strikes in order to get to that green light, right? Well, if I made it $10 wide and I collected nothing for those 2 short calls, right, then I would be at that yellowish light, okay? I know I'm going to be able to collect something. So that's where I'm going to start. So I'm going to go about $10 wide on this and start to sell the 95 and a halves. And you can see it's outside of that 16 delta. So I'm good with that. And then go $10 down. That's just slightly inside of it. So it kind of makes up for it. All right. So we make this the 1 lot, and you can see that brought us down to about $6 on a $10 wide. That's 60%. That's the green light, right? Does that make sense to everybody? I'm doing the math in my head. $6, and the way to figure out the math, to make it easy for you, what you would do is say $6.04. $6.04 divided by the width of the strikes, which is $10, gives me 60%. So we're only paying 60% the width. That makes it a green light. Okay? Did I mess anybody up with that math? How I did that, where I started out, I'm looking at the 85s, and I'm like, okay, I can easily see that if I just sell the $10 wide, I'm at a yellow light. I'm going to collect something $10 further out. So let's see where it brings me. Okay. If it doesn't get me to that ratio, I might have to go a little bit tighter in order to get that ratio into a green light. Okay. If you collect a little more of a credit, it could bring it into a green light. It's not always going to. And if it doesn't, then look at it maybe a little bit further out in time, or just look to do the straddle. Right. So again, this follows that rule in and around what I was talking about, with low volatility and everything else. All right. Knowing our exit strategy. It's very similar to what we're doing with the straddle. But when the underlying goes and touches our wings, which is the short call and the short call and the short put, once it touches those wings, it's probably going to achieve my profit potential, which is going to be 50% of the max profit, which would be when this is trading $8, because 50% of the max profit, my max profit is $4 in this case. My max risk is $6, right? Anytime you pay a debit, that's your risk. The difference between the debit we paid and the width of the strikes is our max profit, which is $4. So I'm looking to take 50% of that max profit. So somewhere right around $2 increase would put me at $8. Does that make sense? So we're looking at the same thing, 50% of our max profit in this, and 50% of our max profit is $4. So we're going to be looking at cashing out when we've increased by $2. Another thing we can look at is the days to expiration, right? If your days in this trade less than 10 days and you're at a 10% increase in profit, you know, and you have a low risk tolerance, maybe it's the first time you put this on, I would suggest taking it off. I'm usually looking at the 30 to 50% increase on my strategy with this one. All right. But you can follow this. If it's less than 15 days in it and you're at a 15% increase in profit, you can look to take it off. All right. Another thing I wanted to mention with this strategy, if you notice, when I'm doing a lot of these, I'm shooting for those stocks that are about $100. If you're looking at something like a GE or a Ford to do this strategy in and around, I would probably just go with the straddle than trying to define that risk. So, but it's when you start getting up into the hundreds, this starts becoming a little bit more feasible. When you're down in the below 50s, it's a little bit more difficult. You're going to be looking at yourself, why am I selling this 16 delta straddle or 16 delta call and put for, 10 or 15 cents? If you're only going to get that much money for selling that, I would probably just leave the short aspect of the iron butterfly off, which is just then playing the straddle. All right. So you can follow that as well. All right. Max profit is not unlimited. I don't know why that's on there. But we'll go over max profit on a different one. I have the wrong slide on this. So I'm just going to go over here to the other one and let's look at this chart. So what we talked about, our max profit is the width of the spread, which is $10 minus the debit. It's $6 here, let's say. So our max profit is $4 or $3.95 if you want to hit the nail on the head. Our max loss is the debit paid. Anytime you pay a debit, it's that debit paid. Our break even is the long call and the long put with the debit accounted for. So on the long call, we are trading the 85 call. We add $6.05 to that 85 strike. That gives us $91.05. So when the underlying trades up to $91.05, the upside, that's where we've breached our break even. And that's at expiration. We can only really give the break even, max profit, and those kind of things when that's going to happen at expiration. The very last day, everything's expired, worthless, but the ones that are in the money, that's where they come up with that break even, okay? So we would have to have gotten to that $91.05 by expiration. A lot of things can happen in between to get us to our break even or our profit target, like volatility expansion will get us there much quicker, and I'll show you that when we pull up the chart. And then to the downside, we take that 85 minus the $6, and that gives us $88.99, or it's going to look, or $79.99, or did I do that math right? 85 minus that is 79. So, or sorry, 78.95 is where our break even is on that side. Okay. When the exit side is all the credit selling strategies also. When to exit. Oh, the when to exit slide is for all credit selling credit strategies, right? No, for the buying ones, I would say it's for the long strategies. So this would be a debit strategy. You could interchange that one. Okay. All right. So let's pull up the platform real quick, and we can go over these or the chart. We can go over these break evens and stuff like that here. So we did this with the 85 strike. I told you I was going to go down to the 75 because I figured that would be enough to get me my profit target. And then the 95. So it's $10 wide, collecting $6 and some odd cents. So this is what I was talking about. It's, mid-range. It's above 25 and, below 50 for the target. That's a pretty good wheelhouse for this. And the reason why is there's enough volatility to get my wings wider. Okay, there's enough volatility to push that 16 delta out a few ticks. When it's really low, that 16 delta is going to be just so close. It's going to be hard to make the spread with. Or if it is, it's just not going to be a whole lot of money. So I'd rather have a little bit of volatility in there to increase this spread width. And that's what we're trying to achieve with this. $6. So let's look at the Analyze tab to show you what happens this trade. This is showing what the circumstances are around this underlying for just today's trade. And what we can see here is right now, if we put this trade on, nothing happened. Right now, we would be at break even. We could sell it out for that $6.04. Now, if we implemented this with volatility that was too high, let's say, and we just adjust the volatility number in here, you can see that if volatility starts coming out of this, we are going to start losing money. Even if the underlying doesn't move, no days pass by. There's no theta decay. There's no movement in the stock to adjust our profit potential. Just the volatility going down by a couple percent, you can see that would negatively affect us. That's why we want to get involved in this in and around an environment where we expect the volatility to expand for us, because when the volatility expands for us, even if the underlying didn't move, no days went by, volatility just expanded today, you can see that we are at profitability. You can also see that when we were at zero, one other thing that I forgot to note on one of the previous webinars that I noticed recently is you will see that when I start increasing this volatility, you're going to see, well, of course, they're not going to give it to me now that I've already done it once. You will usually see like this red line start moving in closer and closer. And that just is saying that the break evens are moving in a little bit. And that's because our debit is starting to increase, meaning that we're getting paid for that. And that's really what we want to have happen, because if we are directionally wrong and we don't make it all the way there, if the volatility, to get to our 50% of our max profit. Remember, the only way to achieve our max profit in this strategy is if the underlying ended right at 85 at expiration, ended right at our short strike at expiration. Maybe, if it's the 95 strike, it just settles 95 even, right? Or 94, 99. So that these basically our short strikes finish worthless and we gain the money from the movement, right? But if volatility expands for us before that, we could get out of our 50% increase in max profit by the time it reaches, say, 90 or 92 or something like that. You're going to see that happening. When should we use this strategy? John's asking. Great question. This would be when the underlying is trading like, I'll give you a perfect example if I still am looking at this chart. Bitcoin, not necessarily using this for Bitcoin. I think Bitcoin may have had a cardiac arrest. But when we start seeing the underlying, see, you get these big moves and you start seeing the underlying kind of wind up tight like this, you're expecting a big move to happen. That's what I correlate this to. Back in the day when you had the balsa wood airplanes and you had the little propeller with a rubber band on it, you'd roll that rubber band tighter and tighter and you'd see it just really start to cinch down and feel that pressure, that tension building up. And then when you let go of it, the tighter you wound it, the faster it spins out, right? Well, the same thing goes with stocks. Usually the longer they spin tighter and tighter, the more they snap, okay? And that's kind of the idea on the charts that I'm looking for, to give you a visual. When you feel that, you can kind of maybe I've been doing it for a long time. There's a lot of times where I start feeling like there's some tension being built up in the stock market. And this is kind of what it looks like. And then you're expecting that move. So anytime you see your chart kind of doing this, that's when I would start to look to expect this expansion in volatility or big move. The other thing would be heading into a binary event like we were looking at Target. You can see Target has a binary event. It's several days away. So we'll start to see continued expansion and volatility like we did for the other going into earnings. You can see going into earnings, they expanded, right? That's what we're looking for. As long as you have the expectation of earnings and volatility expansion. So for instance, with Target, we're kind of right now, right around in this area, and you would see that heading into that event, volatility expanded. So if you're having either one of those kind of ideas, you can be looking to implement this. Generally speaking, I'm looking for it when I feel like there's a breakout happening, when something starts winding up tight, like right in here. I'm starting to feel like, hey, you know what? We're getting ready to have a big move happening. Didn't necessarily happen there, but I probably would have gotten that 16 delta, 80 or 50 days away. If I put it on right here, that's probably 50 days away. That probably would have reached that 16 delta. All right. And we would have been getting that expansion and volatility, hopefully. Okay. Does that make sense for everybody so far on that? So let's look at another example. You guys can throw it out to me. If you guys have examples you want to look at, please feel free to throw those out to me. I will show you an example real quick of while I'm waiting on you guys to throw something out there. Let's look at one that's really high right now, like Adobe. We can look at Adobe, and I think it's up in the 80s or something like that. You can see it has really high implied volatility. Volatility is even coming out. But it's up in the, oh, they might have had earnings today. Anyway, they were up in the 80s earlier, so that's why the volatility is coming out. So if we looked at this, though, it's still above that 50 that I was looking for, right? Closest to the at the money, 52.5. It's going to basically be a pick 'em between these two. I'm just going to try and go to the one that has the closest deltas to even, and that's probably the 55s. So I'm going to go with the 55 delta. I'm going to buy that one. I'm going to buy the 55 there, buy the 55 there. Look at my debit, $27. So I've got to think about $35 wide would put me at about 60%, right? Doing the math in my head, if I can get like $3 or $4 out of each side, that would probably put me down to 20 on a $35 wide strategy. That puts me somewhere in the 60s percent wise. I know I'm good at math in my head, you guys. Some of these things, that's why I'm like you're going to see it's the 16 delta, I bet. So pick them. We did the 55s. I said $35 higher. So $35 higher puts me at about the 80, right? So I'm going to sell that one. Did I say, is that 35? So that's 80. No, so it's the 90. See, look at that. I looked at that, said it wasn't the 16 delta. I redid the math in my head and realized, no, it's the 90. So that put me right at the 16. $35 down to the downside is the 20s. So then I would sell that 20. Now, note, this is the one that has a high implied volatility, right? Volatility is coming out. So that's a first indicator that we probably shouldn't be doing this strategy around Adobe. Because if volatility continues to come out, we tomorrow might see ourselves, even with Adobe not moving, losing some serious money. So we want to stay away from that. All right. So 21.58. This is just an example to show you that it will probably fit the rules. Divided by $35 width of the strike, 61. So that's a green light, right? Except for the environment. So we hadn't even gotten to the strike location, right? And we would have known that this is not the right environment. So you shouldn't have gotten that far down the checklist of, I've got too many charts up for picking the right strike. What were my rules here? So we are picking the right environment. We would have known immediately by picking the right environment would mean that Adobe would have not made the list, right? The right underlying, it fit. The right duration, it fit. The right strike, it fit. All the other things fit except for that environment. And that environment, the reason why I started putting it first is because that is first and foremost. The environment is volatility in this regard, and volatility is the end-all be-all, right? You can do ETNs, absolutely. ETNs, ETNs or ETFs, any of those. Yes, it will work with futures as well, you guys. If you like to trade the futures instead of the ETFs and stuff like that, yes, you can do that as well. Follow those rules though, because they are going to go hand in hand. All right, volatility, yes. I would say volatility somewhere between 20 and 50 is usually best case scenario with the expansion of volatility. Oh, Eaton Corp. Not an ETN, but Eaton Corp. Got it. So then if we're not talking exchange traded notes, then we're going to be looking at ETN. So let's look at ETN. So Eaton Corp, we're going to look at the monthlies, right? One of the first things we want to look at is whether or not we can even trade this underlying. And I would have to look at this during normal trading hours to see if it fits the rule of thumb. But just off the bat, under $100, 10 cents wide, it's not fitting that rule. It's about 15 cents wide. And again, when I'm talking about the width of the strikes here, you guys, if you guys have been trading options for some time or are familiar with ETN, Eaton Corp, okay, and you've traded it a lot, you're used to where you can get filled and where you aren't going to get filled, stuff like that, then yes, you can go a little bit wider than my rule of thumb of 10 cents wide on a stock under $100. That is not a mandate. That's just green light. I would say then you're going to have to go with like a yellow light would be, on a stock under $100. I would not go wider than 20 cents wide ever on a stock under $100. All right. But you can expand those, maybe double my parameter as a yellow light, but I wouldn't go much more than that. You just end up giving up too much edge. And if volatility is to expand like we want it to, and we get that outpaced move like we want it to, know that when the volatility comes in there and there's bigger moves, the people, the participants making the markets are not willing to make tighter markets like they were before, right? Because anything can happen. I could get hit on my options and go to lay it off on the stock or go to do my other pairs trade, and the execution gets lost. So I need to be compensated for that risk of me in this volatile market getting my other leg. So I'm going to make the markets wider. Does that make sense? So know that when it's 20 cents wide in a relatively not volatile market, it's going to get a lot wider if the volatility expands like we want it to and we get a big move. All right. So you're going to have to play around with that in your own head. If it goes from 20 cents, it's probably going to go to 40 cents. All right. So just know these spreads are going to get wider the higher volatility gets. All right. So it would be a yellow light for me. The next thing I would look at is the current IV percentile. It's 93. That kicks it to the door right away. As you can see, it's at its highest implied volatility percent. Now, we didn't go over this in this webinar, so I'm going to go over it real quick. When we're talking about implied volatility percent, I am not talking, you guys, about the VIX. All right, this is the VIX. I'm not talking about this. This tells us what volatility is in and around the markets as a whole, all right, the equity markets as a whole. This implied volatility tells us what volatility is for this particular underlying. So this is telling us Eaton has an implied volatility of 32%. Remember, it's a decimal, but we multiply it by 100. That gives us percent. So 32%. That doesn't really tell us anything, because if we looked at something like Tesla, is the first one I can think of that has the highest volatility. You can see this is at 70. Okay. So is 70 high for Tesla? Not really. You can see it's kind of middle of the road as of lately. So 70 is middle of the road for Tesla, but we were just looking at Eaton, and 32 is high. Like Tesla never gets down to 32. So what we have to do, implied volatility percent tells us where this particular underlying's implied volatility is in relation to where it's been in the past. Okay, because the past isn't the best indicator of future, but what this does is it gives us a really good idea as to the range of this underlying. And the underlyings usually have a pretty set range. It doesn't mean that it can't go higher. Like this volatility was high at one point, but you can see it went just higher yesterday. It doesn't mean it is at its highest. It just means that once we get to these extremes, it's going to want to revert back to the mean, which is why I don't necessarily mind having the underlying have a 50 IV percentile, as long as we expect the volatility to expand, like going into an earnings or something like that. All right. So this one I wouldn't, because we're paying so much for volatility. If this just even settled down for a minute, we would see our premiums go quickly. Would you do this? Would it work for SPY? Absolutely, Doug. And as a matter of fact, in my last webinar, when we were doing it on the straddle, I had done this example specifically with SPY. All right. So we could look at SPY might be a little high right now for this trade, but if it was fitting the other rules, then I would say, yes, you could do it. But it's above 50 right now. When I did the straddle, it was in the teens and got the move, volatility expanded, all of that good stuff. And it worked out well, but it's a little high right now. But across the board, they're high. If you expected it to continue to go higher, then that's one thing. But I would be really skeptical after the moves we've had that it's going to really continue to expand much more. Okay. Especially because that one spike was on this. So it's pretty high right now. So I would stay away from SPY, but that's in this particular strategy right now. Okay. So really, these ones down here are the ones that are the best examples, are the ones that I kind of came up with. Let's look at ADM. ADM might not fit this rule. So it's under $100 stock. It doesn't fit that rule. I'd have to look at this during normal day trading hours. ADM is one of those ones I like to trade for earnings. We could look at Dallas. We could look at Delta Airlines and see that it's not necessarily fitting this rule, but look at it during normal trading operations. Those will be a little bit tighter. So Target was the one that's fitting our rule right now. We could even look at XLV as it's above 30. So I'm going to stay away from that. Stick with Target and go through those steps like I did. Target 83.5. That's going to be this strike right here, closest to, oops. I want the 83.5s. Buy. So $4. Now I'm thinking in my head, how wide does this have to be in order to get to my 60%? It's probably got to be about $7, I'm guessing. So let's just add $7 and go to the what is that? The 90s. Let's just do the 90s because I go any higher than that. Remember, I was like, what's it worth selling it for a teeny or something? So 90 to the downside, that was really $6.50, and $6.50 to the downside gives me the 77s. So I'm just going to click on it without doing it. Is that right? Did I make that equal distance? 6.5 up and 6.5. All right. So 6.5 and 6.5. So we got 6.5. Our debit is less than that 60%, right? So we can, or less than that, 66% is what I think I was saying. So $3.60 divided by the $6.50, right, equals a 55%. So that works. Only 22 days left in Target on the example I'm giving. You're absolutely right. So that's why it's way less than what we should expect. But, in that, this rule for the spread width, when you're clicking on that 16 delta to get it, you're probably going to be able to make this work. But you're right. Thank you for that catch, Banu. That should be further out in time. Can I just change this to the December and bang it? December. It's not going to give it to me. You can let me do that? No. So let's just do it this way. I may have locked it or something. All right. So you're right. Banu busted me. So let's go with the closest to it is the 85s then. So we're going to buy the 85s. We've got $7. So I know that $10 to the upside is probably going to get it to me, right? Because it was a yellow light without it. And then selling that one gives us that $6. That's the best example I can come up with right now. And that would be as if we expected Target to have expansion and volatility going forward, which their earnings are coming up. So I would expect that. I think their earnings are landing somewhere right around in here. So we're expecting that earnings to happen and a big move on that earnings, which we've been seeing lately. So I wouldn't expect that to necessarily change. Can you show what can be done to make the money with Micron? Are you talking about MU, Micron? Right? So I'll do this one as the example. So let's look at Micron. First thing is the environment we want to really look at. And it's 54. So where's the earnings? I mean, if you were expecting the earnings to come out in the cycle that we were going to be participating in, then that would be okay. It is. So this month has earnings in it. So we would expect volatility to continue to expand into it. Yeah, you could have these little dips going in there. We don't care about that as much as long as volatility continues to expand for us. All right. So Micron, and then we look at the nearest to expiration. My rule of thumb, a stock under $100, move it is 10 cents wide. That fits this rule. All right, so we go out here, closest to the 36 or the 3670 is this one right here, and we are able to get the deltas right, very close anyway, right? I'm buying this call, so I'm buying 50 deltas. I'm buying this put, and I'm buying negative 52 deltas. So plus 50 minus, or 50 plus a negative 52 is negative 2, right? So it's slightly bearish to the downside. I'm okay with that. It's pretty much zero. So we're at $6. So when I'm looking at $6, I think I'm going to have to be at least probably $7 wide to get to that profit target. So what's $7 to the upside would be 44. Look at that. Falls in line pretty close. And that's just guessing. So $7 to the downside is the 30s, pretty close to that 16 delta, right? So we have $7 wide and collecting, or we're paying $4.42 divided by the $7 wide gives me a 63% the width of the strike. So that fits. Okay. Does that make sense? Oh, yeah, you were on it with the D's 20 earnings. So that works with this. D's 21, we've got that full month of volatility expansion. So that one's good. That would work as well. That work for you guys then? Pretty simple, right? You know, if you don't want to do the math in your head like I do, just know that you're probably banging around somewhere around that 16 delta. It's pretty easy. Would you sell both call and the put? I usually would. Yeah, because, you know, in this case, I really don't know which direction it's going, right? It could go any direction, especially right now. We could snap back to the upside or we could continue on to the downside. I really don't know, to be honest. I mean, the charts are not giving us a tea leaf to even look at. It doesn't seem like. So these are good for this kind of environment when you don't have any idea of directionality. And at this point, I can be honest and say I really don't. I think somebody can knock it out of the park with earnings and still see them go negative on the day, the way the markets have been going. I mean, same thing happened with Microsoft. First reaction was to the downside, even though they beat. All right, so that's how you set that up, and it's pretty easy. So without further ado, you guys, we built all this out to where it is so much easier for you guys to go through and check off the webinars when you're done watching them. You can just click it off. There's several webinars within here that also have this same status where you can check it off once you've watched those videos. So we're going to be giving you guys, we've set that all up. We want you guys to test it out for us, give us some feedback. So we're going to be giving you guys 1 month for $7. Premium membership trial. It gives you access to everything that I've done, all the webinars I've done. So if you wanted to watch anything from Iron Condor to whatever, you can go in there. There's over, it says 50 here. There's over a couple of hundred now. And there's different courses like, you know, with the volatility. I'm talking about volatility a little bit more in this webinar than I would for another webinar just to learn about it, let's say. So this course that we're taking right now is very volatility focused. So other videos may have some other material that you didn't learn about in another Iron Condor webinar, let's say. So you get all of that for $7. You also get the trading workshops. You get full access to these shorter videos where I kind of go over each each strategy, give an underlying that would be tradable in that environment and fits all those rules. So I give you a good example of that in a short 15-minute webinar. So you don't have to watch the hour-long one again. You know, I would suggest watching the hour-long one again relatively soon afterward. I'm talking maybe a couple of weeks down the road. You decide to implement this strategy, go back and look at one of those shorter ones. And then you get priority access to the webinar, the live webinars. You also, one thing we don't mention here, you guys, is you get unlimited access to me. If you send me an email, I'm going to respond. If I can't respond in an email, I'm going to give you a phone call, figure out a way that we can reach out. So if you guys have learned anything at all, I know it's not hard to figure out how to do a long iron butterfly, but the fact of the matter is the people online are not going to tell you you need this volatility expansion and give you strike location. Like, who knew that you need to sell your wings somewhere around the 16 delta or collect a certain width of or be able to have a red light, green light on the width of what you're paying, your debit of the spread, right? So all of those things, I mean, you're not going to find online, all right? And like I said, unlimited access to me. So you get all of that stuff and much more for $7. So I would highly suggest taking advantage of it, especially during earnings. If you guys ever wanted to trade earnings, I'm talking about earnings in every single webinar, right? So one thing we can do is educate ourselves to increase our chances of success. And that's exactly what I try to do in all of my videos. So if you've learned anything at all, if you've enjoyed this webinar, take advantage of the link in the chat window, which isn't in the chat window yet. Let me get it over there. I don't know where it went. I had it in there a second ago. All right, copy and send. There you go. It's in the chat window. So click on that link. It takes you right to this on our homepage. You can get signed up for it. You can also reach out to us at 310-598-6677 or email us at trading@protraderstrategies.com. I want to thank you guys all for attending this. Later webinars, I'm going to be drilling down on different option components, how I trade options, and when and where I find them appropriate, especially in those daily market commentaries. I'm talking about trades all day long. This is the link. It is not a clickable link or a hyperlink. You're just going to have to pause the video and type this in. And I want to thank you guys for watching. Again, you can contact us at 310-598-6677 or trading@protraderstrategies.com. All right. So take advantage of this, because one of the few things we can do to set ourselves up for success is putting these strategies on correctly at inception. After that, we need to be mechanical. All right. But beforehand, we need to set this up properly. And that's what I try and teach you guys in every one. All right. Thanks for another great webinar. Thank you, Ted, for the kind words. And that's about it. Other than, if you can't take that, take it easy. JQ does that to his friends in his sleep. All right. Cool, guys. That's about it. Take advantage of that for $7. I mean, you are not going to find a better deal on the web. I can guarantee that. All right. Cool. All right. See you guys in the daily market commentaries. While he's back to the MJ stocks. Not much options on those right now. All right. Take care, guys.